Welcome back. Well, good recovery is what we're seeing. We moved into the green after starting off on the back foot. Let's see whether or not we can hold on to those levels. But for the time being, well, it's a good time, to chat with another management. We have Engineers India, that's EIL. Well, we have the management who's joining us on the show to help us understand what is the roadmap, what are the goals, and what is the outlook that we have for FY23. Well, Vatika Shukla, the chairman and MD of the company, joins us on the show. Good morning, Ms. Shukla. Thanks so much for joining in. Always good speaking to you. Well, first things first, if you could tell us what was the order inflow that we saw for the company in the past year, that's in FY22, and for FY23, what kind of a number are you looking at in terms of order inflow? What does it take the order book to?
Thank you, Prashant, for having me here. It's always a privilege to be part of your show. For the last year, we had an order book which was mainly on technical projects of about 1,600 crores, close to about 1,650 crores. And the outlook, of course, in this financial year is extremely promising. And the strength from that comes from the diversification and the sectors that we are now looking in, where our teams have put in extensive efforts, be it the energy management systems, both in the petrochemical, oil and gas sector, as well as into the infrastructure segment. Looking at petrochemical growth, which is really going to embolden the investments in the oil and gas sector in the core. We are also looking at diversifying our own expertise into areas like the subsurface work, which we are again undertaking. Even looking at projects which are going to monetize coal, which will bring in energy security, look at clean coal technologies, and sustained efforts from our side have actually yielded very good results of late. And we see that as a very diversified yet very robust portfolio. Coupled with that, we are also looking at some projects in the onshore facilities of our majors, oil majors, where we see a lot of replacement of units, which will bring in higher efficiency, higher intervention of technology, and looking at minimizing the fuel consumptions. So overall, we see a diversification into newer diversified products beyond the commodity
Ms. Shukla,
products. Looking at energy efficiency.
Ms. Shukla, we take that point on board, and you've got your game plan in place. But if you could give us a couple of numbers, order inflow, order book, what is the update? What is the order inflow you're expecting in this year? You could split it up if you want, in terms of verticals. And what does it take your order book to? Go ahead. So
what we expect is we have in the oil and gas sector, we are looking at an order inflow of close to 2,000 crores in this financial year. And we hope to do it in the first 3 quarters of the financial year itself, which is a substantial upward trend from a few years previously. We also see a sizable order inflow of about 1,200 to 1,500 crores in the oil and gas sector itself. And we see a sizable amount, I would not be able to share the numbers with you, in the infrastructure segment as well.
So 2,000 crores is overall, the overall order book is 2,000 crores. Out of that 2,000 crores, 1,200 is in the oil and gas segment, is it?
No,
no. It's separate.
What I'm saying is it is in separate verticals. So we categorize it in typical verticals.
Okay.
So we have a very, very robust and very promising outlook in this financial year.
Okay, got that. Can you tell us a little more about the transition into the renewable energy segment? Some numbers. What could the growth look like in that? What are the opportunities that you see there? And how does all of this translate into your own bottom line or even your own revenue stream?
Sure. So, you see, to begin with, EIL has transformed its vision policy. It has also been one of the companies in the forefront to declare itself net zero in 2035. And we have a very expert team in place who will also fast track it even before 2035. So we'll be there much before our targets. Now, this being our goal, we see the benefits of the learnings and the technologies which we will utilize to put back into the customers in the market. And in case of the clean energy space, in place of looking at minimizing energy consumption, reducing carbon dioxide footprints. This will be a very important step for EIL to diversify its services, offering to the entire industry the interventions required towards net zero. So this is in the next 2 to 3 years, we would position ourselves as a global leader, offering our total energy solutions in this era where a sustainable future is very, very important for each organization.
But I didn't get any numbers. If you
that,
can tell us what would the financial contribution be to your books?
See, the financial contribution would be into the high-end technical services. So, wherein in the top line, it would have not as big as an impact here, but it will have a significant impact into the percentage margins, would be upward of 30 to 40% because these are high-end technical services.
Okay, all right. Ms. Shukla, if you could give us a few more numbers then. You're sitting, I think, on a large order book. I think it was around 8,000 or 9,000 crores. Plus, you're guiding that order inflow from both your verticals will be more than 3,200 crores. Plus, there'll be some additional order inflows. So what is the execution that you're looking at? So that's point number one. That's the revenue number that you can deliver for FY23. And also, I think you're sitting on a reasonable amount of cash. So could you quantify that? How is your balance sheet shaping up? And any plans of rewarding your shareholders?
See, the shareholders this year have been rewarded much better than last year. It's almost, EPS is 47% up from last financial year. And even if you see the PAT, it is 33% up from last financial years. Now, it would not be prudent for me to give you a number so as to what our turnover would be in this financial year, but it will be much better than what we have done in FY21-22. Now, these projects which I mentioned actually fall in two baskets. One basket is the high-end technical work, which we finish normally in a 6 to 8 months' time. And the realization on the top line and bottom line is very significant. It is realized in the same financial year. But some of these projects which have a gestation period upfront and have an implementation time cycle of 3 to 4 years would have an increase in turnover steadily as we go into each financial year looking forward. So sum and substance, we are looking at a very good margin on our technical services, the consultancy segment, and we are looking at reasonable growth and margin in our OB segment and LSTK and OB segment.
Okay, Ms. Shukla, we will leave it at that. Thanks a lot for joining us and all the best for the year to come. But let's get back to the big global theme now. With the Fed having accelerated rate hikes this week, global central banks have joined the chorus of outsized rate hikes. We saw the Bank of England with a 25 basis points hike. The Swiss National Bank came out with an unexpected 50 basis points hike, the first time in 15 years. What does this mean for the macro economy? Taimur Beg, Managing Director and Chief Economist at DBS Group Research, joins us now to talk about that. Taimur, good morning and thanks for joining us. I don't mean to use the cliche unprecedented times, but this definitely seems like that, right? I mean, the Swiss bank raising rates for the first time in 15 years. So this coordinated effort to tame global inflation, what does this really mean? I mean, are we staring at a huge recessionary environment, not just in the US, but across the world? And if yes, what does that mean for a market like India?
So definitely a first time in our professional careers, right? And I think it's actually not a trivial point that from a trader psychology perspective, from market participants perspective, seeing something so unprecedented obviously comes with an added degree of stress and sometimes panic, if you will. If we dealt with high inflationary environment on a regular basis, no big deal, which is why I think that Indian market participants, having dealt with high inflation and currency volatility episodically, not in the last few years, but episodically in the last decade or so, are probably better prepared to deal with risks of stagflation or runaway inflation or intra-meeting policy action. I think Indian market participants are more savvy about that. But that's enough about psychology. Let's talk about the global market picture. To your point, the Fed certainly has ramped up its playbook, and high interest rates are here to stay. And the delta, of course, has changed quite dramatically just in the span of the last 1 week. We were not even seriously thinking about anything more than 50 basis points last Friday. And look where we are now. So I think every rate hike by the Fed, whether it has happened on a gradual basis or in a rather dramatic manner as it is happening right now, has come with its set of accidents. Early 1980s, the debt crisis in Latin America. Early 1990s, the Mexico crisis. Late 90s, the Asian financial crisis. And of course, 2008 crisis was preceded by a sustained Fed rate hike cycle. So the big question to me is not the likelihood of a recession in the US or the likelihood of a strong dollar, it's the likelihood of accidents. Are we going to see crypto market volatility spill over into the real sector? Are we going to see some banks get in trouble, whether they're exposed to peripheral European risk or some sort of emerging market dynamic? That's the big concern that I have. Because if those sort of accidents start to manifest, then even our general constructive view on India, blessed with high international reserves, current account balance, coming into this predicament not particularly adverse, all those mitigating factors that we are keeping in mind right now with respect to India, that would then go out of the window because then it's a global crisis, accidents happening in here and there, and contagion spreading. So to us right now, that's the big question for the rest of the year. Are there heightened risks of accidents here and there?
Taimur, I mean, this particular correction has been induced by high inflation and now central banks making liquidity scarcer, right? US dollars more scarce. So it's not like a problem which has been unearthed like what we saw during the global financial crisis or right, other contagion. So this is a broad-based, I mean, very knowingly central banks are effecting this change, this regime change. So this point about accidents, the second order impacts, I mean, what is the probability of this really taking place? And if you can give us an example or two, I mean, in what way this will manifest?
Correct. So the classic example of this would be 2006, when the whole world looked wonderful and everybody was making a lot of money. And Raghuram Rajan, who at that time was at University of Chicago, just had finished his tenure at the IMF, gave a speech about risk manifesting in global markets because everybody owns the same sort of assets. And people like Larry Summers found it was rather old-fashioned and inappropriate in the context of modern finance. And 2 years later, you saw the moment the rates went up, US housing market slowed down, and there was a huge worldwide accident, if you will. Ex post, it looks, it sort of, we should have seen it coming, but we didn't. So that's the question now that I have. So I saw recently a set of analysis done by the European regulators about the nexus between bank lending and crypto investment. That has there been, outsized exposure by certain banks. I don't think many Asian banks are being considered in that danger list, but say banks in the US or Europe who have gotten themselves overexposed to the crypto cycle and the ongoing correction that we're seeing, whether that takes a few asset managers or hedge funds under, and if that then creates some sort of a panic in the banking world. So that could be one area of risk one can think about. The next one would be your classic one going all the way back to 1997, and we have seen that episode play out, which is the classic currency mismatch. Have local currency, local market participants borrowed a lot in foreign currency, and they have domestic currency receivables, but hard currency payables, and the currency come under stress, and then what happens? Again, I think these set of worries are not necessarily manifestly relevant for Asia. We are taking a very hard look at risk of currency mismatch on the balance sheet of both private and public sector in Asia. I think this is a bigger risk in other parts of the world, whether it's in Latin America, Eastern Europe, or Middle East, and so on. So, the likes of Lebanon and Turkey, and perhaps Venezuela, Argentina, I think those are the risks. But I just want to reiterate my earlier point that just because these risks of accident are not necessarily visible in the horizon in the Asian region does not mean we will not get affected by it. As we have seen in past crises, contagion happens. Global portfolio managers sell emerging markets wholesale. They don't necessarily differentiate between good credit and bad credit. That's the risk that we have to be cognizant of.
But to be fair, no rate hike cycle has come and gone without major asset market dislocations or a credit crisis or even a currency crisis, right? In the fragile parts of emerging markets and developed markets. So I guess that was to be expected. The only question now is how much of the poison is out? What's your best guess on how could it get worse before it gets better?
Yeah, it's always the darkest before dawn, right? So let's try to find some glimmer of hope. Look, as far as the U.S. equity market is concerned, that is the biggest issue right now, that it has had a huge correction. And as a result, it has had concomitant impact on investor desire for risk assets around the world, and risk sentiments have worsened substantially. I fear there is more selling in store as far as the U.S. markets are concerned, because we're not done with the rate hike cycle. We are hoping it ends this year. We hope that, 3-4 jumbo hikes by the Fed would be the end for the cycle. But the problem is, we have such opaque understanding of the inflation process right now. The U.S. Federal Reserve may be capable of weeding out any inflationary pressure coming from the housing market and perhaps from consumption, but would that be sufficient to bring inflation down to a tolerable level, or will they be compelled to keep hiking? So that's a residual risk for risk assets around the world. And as far as Europe is concerned, which is sort of looking at the eye of the barrel, if you will, with respect to energy security, we're now in the summer months and not a lot of air conditioning demand. But once we head into the winter months and heating demand begins, this shortage of gas and oil could be a major exacerbating factor, both for real economy as well as for financial markets. Now, I want to make one point that I feel that we don't talk about enough. We are living in a globalized world, and finance is globalized, and therefore all markets are moving basically in the same direction. The economies are not that globalized yet, meaning what is happening in China is entirely different from what is happening in the rest of the world. The rest of the world, by and large, reopened last year, so COVID-related issues are behind us. For China, the battle is happening right now, and they will get a big reopening dynamic taking place in the second half of this year, which will spill over into next year. And that could be one glimmer of hope. Just as we in the rest of the world are dealing with high interest rates, they're still using policies to support the economy, and they probably have a lot of residual upside to consumption left. And whether you're sitting in India or elsewhere, exporters will benefit from that cycle.
Okay. By the way, the market's taken a dive once again, 30 points lower. Taimur, just one last very brief response to this one. We've seen competitive devaluation all these years, right? Are we starting to see the opposite of that? In a way, the reverse of the so-called currency wars. And what impact does that have? I mean, if you are in the midst of that, for example, there was expectation of something similar from the Bank of Japan as well. Nothing has happened. Maybe it'll come later. But if we are seeing that, starting to see that, what are the implications?
Prashant, I think that if you have fragility built into your economy, where you have currency mismatch, then you cannot afford substantial devaluation, and you have to fight and try to keep up with the Fed to keep the interest rate differential small. But if you're like Japan or most of Asia right now, including India, which is we're enjoying a reopening dynamic from COVID, our tourism sector is going to do very well this year, and our competitiveness will be boosted by the weakening of the currency. I fully appreciate the risk of, weak currency bringing in inflationary pressure, but it also brings in competitiveness, it brings in foreign tourists. And let's also not downplay the strength of the export cycle. Export numbers that we have available for the month of May, India, Indonesia, China, Vietnam, all double-digit, mid-teen, on the back of a year ago when it was already popping, because that's when the first reopening happened. So I think that we have this 1-2 tailwind with us. We can take some exchange depreciation, not the end of the world.
Okay, Taimur, pleasure speaking with you. Thanks a lot for joining in. And this has been a tough time across the board, right? Across asset classes, equities, cryptocurrencies, all are seeing a major slide. Hopefully, next time we speak, things will be better placed than we are right now. Thanks a lot for being with us. That's Taimur Beg, just analyzing the macros for us. But let's get down to the micros now. The market has sort of recovered from the lows, but it's still very, very choppy. Coforge is one stock that's been buzzing in trade. Nimesh highlighted the stock in Standout Brokerage Report in pre-opening in case you listened to him earlier. But in case you missed it, let's revisit the same. Nimesh, over to you.
Thanks, Sonia. So the stock is up 2% on the back of a decent upgrade from Antique. So they've upgraded the stock to a buy now from hold, but they've cut the target price to 4,700 versus the earlier target price of 5,200. But even at 4,700, it suggests a potential 43% upside from current levels. Now, Antique believes that the company can maintain an organic top-line growth of 15 to 20% in constant currency terms over the next 2 to 3 years. In fact, Coforge management has, for FY23, has guided for a 20% constant currency growth. And that Antique believes is very conservative. Now, Coforge has invested in the past in areas which have led to large deal wins, and that momentum is likely to continue according to the Antique note. The key risk factors which have been highlighted is one, the bearings could exit, so that's a supply overhang, and two, the ADR listing. So those two are the big concerns. And on back of that, they're giving a 10% discount to other mid-cap peers like Mphasis and Mindtree. But after 45% correction from the top, Antique believes it's a time to upgrade the stock to a buy now, and they've put a target price of 4,700, a potential 43% upside from current levels.
Okay, all right, Nimesh, thanks a lot for that. By the way, the markets are a little bit low. In fact, we moved to the low point of the day, but Delta Corp is a stock that's doing well, and Sun TV as well. That's a Kotak note that's upgraded the stock, so that as well is up close to around 3%. Delta is up 6%. We saw a bit of a pullback that's got sold into. We're down 65 points here again. Mitesh Thakkar is back with us. Mitesh, in the first 45 minutes of trade, we have moved 200 points. You've got your upper level as well as your lower level. 15,183 was the lower level. How do you approach the index from here? And also run us through your picks.
Yeah, good morning, Nigel. I think, this is again looks like a bounce from levels of 15,150 thereabouts. I earlier in the day talked about that's the weekly support range, 15,150 to about 15,050. We got a bounce from there, but I think again the structure, for me is very weak. So I'm not very happy with the fact that this rally my belief is that eventually this rally will get sold into. So we're still getting a negative bias. I have a sell on Power Grid. I think that's a stock which has broken down. That's a sell with a stop at about 217 for targets of around 205, which is close to the 200 average area. And the other one is Godrej Consumer, which is a sell with a stop at about 730 for targets of 685.
Thanks a lot for that. So that's on the stock markets, but let's talk about the world of commodities. There's a rebound that we saw in the price of crude after the new Iran sanctions fueled more supply concerns. Manisha Gupta is here to talk about the commodity and the currency space. Manisha, what are you looking at?
I'm looking at metals as a sector, Sonia, because in the last 24 hours, we've seen a bigger hit coming in for this area. 1 to 3% of a decline in the overnight markets, that is in the New York session. And the Asian markets have opened 0.5% to 1% weaker yet again. There is worsening outlook for the global growth demand, and inflation concerns are still on the higher side. And it's not just the US Fed. You have other central banks as well increasing interest rates, and that has led to some bit of a risk off. We have seen equities decline, and so is the case with commodities. Also, JP Morgan says that S&P 500 implies that there are 85% chances of a US recession. There is a longer report from JP Morgan as well, and that seems to be bothering the markets early Asia right now. And then you have seen US, UK and Swiss Bank as well hike rates, and the expectation that other central banks would be following suit as we go ahead from here. I want to take it metal on metal, and I'll start with copper first, which is trading at a 4-week close. The record high in this year itself was $10,880 a ton. Currently, we're trading at around $9,250 there. Same is the case with aluminum, which is trading at a 6-month lows, by the way. The record high in this year was 4,100. Currently, price is trading at just about 2,500 in the LME markets there. And that just about continues for other metals as well. Zinc now is at a 4-week close. The 2022 high is around 4,500. We are just about holding $3,600 per ton in the international markets there. And the declines have just about continued in the iron ore prices. 3-week close onto that one too. 160 was 2022 highs. All-time highs has been $260, and we're just about holding 130 on this one. This is the picture that you have on metals on a week-on-week basis. This week, actually, most of the commodities are ending into the negative. So steel is down 1.5%. And as you can see, the other metals down anywhere between 4 to 9% as well, with maximum declines coming in for the steel ingredients. Steel clearly seems to be in more pain than other ingredients. So whether it's about iron ore, steel, nickel, coking coal, Dalian coke, all of those commodities down anywhere between 8 to 10% as well. So not a very good week to end with when it comes to metals.
Okay, Manisha, thanks a lot for that. Let's slip into a quick break on that note. On the other side, our special segment, It's the Economy. Lata will get chatting with Puneet Chatwal, the MD and